going to look at associate now. This is the last explanatory video on group accounts. After this part, the next video, I'm going to be solving a question involving control of a subsidiary and associate, just to show you how the group account will be impacted in terms of how you can be tested in exams. But before I do that question, I would like to do this video first to explain the meaning of associate. So in this video, I'm going to cover the meaning of associate. When do you think you have investment in associate, and how do we account for associate? So we'll look at the accounting. And under accounting, it's going to be in two ways: in standalone parent FS, standalone financial statement of the parent, and also we'll look at how is it accounted for in the group financial statement. And I'll end it all with how we'll make adjustment for intra-group transactions. So we'll look at intra-group adjustment. This is what we'll just quickly cover in this video. Once we cover this, then we can go into those questions. So going into the meaning quickly, and I will take you back briefly to when we started group account. And what did I tell you? I told you that you can have investment, but all your investments will either fall into these categories. Is either you have a control, or you have a joint control in an investment, or investment is just an associate, or it's just an ordinary investment, like financial asset. Ordinary investment, which you can as well call financial asset. And how do you know you have this? The obvious indication, which is very obvious to everyone, is when you have more than 50%, you have a control. When you have 50%, you say you have a joint control. When you have between 20% to let's say 49%, thereabout, you say you have associate. And if it's less than 20%, then it's an ordinary investment. So this is the part that we will see when we look at IFRS 9. When you talk of financial instrument, we'll deal with that. So associate is what we want to look at in this video, which is this part. Straightly. And when do you have an associate? You have an associate when an entity or an investor, investor has a significant influence. Only significant influence. Significant influence. When an investor has only significant influence on an investee, then that type of investment is said to be an associate. And how do you know? So when you look at how do you know that this is just a significant influence, the first one is what I told you, which is when the interest is just between 20% to 49%. And likewise, when the guy only has power to participate. In the investees, decision making. So he cannot control the decision. He cannot make decision. He can only participate in the investee's decision making. Then that is an associate. And an example of that kind of situation is when you have, say, one seat. That's an example. On the board of directors. Just one seat. Obviously, you can't make decision, but you will be able to sit in the boardroom. You'll be able to listen. Or maybe just contribute. Maybe make suggestions, but you cannot take decisions. So you'll be listening to, but you cannot tell them what to do. So in that case, you are able to just participate. In that case, you can influence, but you cannot take decision. And that is the meaning of associate. In terms of accounting, like I said, we look at the accounting in two ways. The first one is the simpler one, which is the single financial statement. Remember, when entity A invests in an associate. Yeah, before even talking about the group account, A must record that transaction. So the question is, how does A record that transaction? And the IFRS gives you two options. Yeah, you can either do cost or equity method. Yeah, so I'm going to look at equity method when we look at the group account, because that's a topic on its own. Yeah, but what part is just talking about is in the single standalone financial statement, you can just recognize at cost and less any impairment. So which means you just record a single line on the statement of financial position as investment in associate, which is your total consideration or what you paid for that investment in associate. Then you have to check if there is any form of impairment. If there is impairment, you need to deduct it from that cost, and that is your current value on the single financial statement. For equity accounting, like I said, I'm going to discuss it in the next part, which is on group financial statement. So you'll just understand it once and for all. Because on the group financial statement, you are required to account for associate using one method, which is the equity accounting. This is what you must do, equity accounting. It is not negotiable, and that is our focus, which is what I'm going to explain right now. And what is equity accounting? So let's quickly go through what equity accounting is all about. It's very simple, not even difficult. Right? What is equity accounting? Equity accounting is just saying that your current value will be costs of this associate, which is what you paid, the consideration. Yeah. Then you add the group share. So add the group share of post acquisition profit. Yeah. If more than 1 year, then that will be your retained earnings. It's the same thing. Then you have to deduct an impairment. If this profit is a loss, then that makes this one negative. So please take note of that. But mostly they will always give you a profit. Yeah. So when you less that impairment, the net outcome that you have, it's your current value. And that will be your single line, just one line on the group account, which you will call your investment in associates. So you can see the difference between this and a subsidiary. In a subsidiary, we have to do a consolidation where all the asset, all the liabilities and equity, they are added together 100%. However, when you have an associate, you don't consolidate, you don't add those line by line items together. You only need to record that investment in associate as one liner, and that is your equity accounting figure that you will have as investment in associate. Please take note, it's only one line in the group statement of financial position. Yeah, and what does that mean in terms of accounting entries? Remember, I always like to show you the accounting entries. So on day one, when you buy the associate as a parent, right, what do? You debit investment in associate, yeah, and you credit cash or bank. Yeah, this is for the cost. Yeah, when you buy. Yeah, but at the year end, there will be profit from the associate. Then you post the entries by debiting investment in associate. Debit investment in associate. Yeah, and credit income from associate. Yeah, income or share of profit. It's the same thing. Yeah, depending on the way you name the account. Income or share of profit from associate. And what amount? That will be the percentage share of profit. Yeah, please, with the percentage Just like we say, this one will be with cost, debit and credit with cost, but this is the percentage share of the associate that you will post like that. And that is this part of the entry is what goes into your equity accounting that we are talking about here. This part. That is a debit that you are seeing here as plus. Yeah. So, and if there is impairment, as you know, the debits will go to P&L, which is impairment of associate. Yeah, and the credit will go to investment in associate, which is statement of financial position. So this part is SFP, right? And that is what we have here, this part, right? So very important. That is how you account for associate. The last part, which is extremely important and probably the most difficult part of this accounting for associate, is how do you do intra-company, intra-group? Yeah, intra-group adjustment. Very important. Please pay attention because it's totally different from the way we do adjustment for the subsidiary. And you wonder why so. Yeah, it's different because if you look at subsidiary, we always prepare group financial statement by adding all the lines of the balance sheet and P&L together, both subsidiary and parent. But in associate, we said we don't consolidate, we don't add all those items together. We only prepare just one line to show the interest in associate. So that will make adjustment to also look different. So there are two types of adjustment which we'll look into. The first one, we'll look at the intercompany balances. Yeah. So take for instance, you have trade payables and account receivable. How do you adjust for intercompany balances? Yeah, like I said, e.g., account payable, account receivable. Yeah, please note that nothing is done on this one. No elimination. So don't worry, that's a good news. No elimination. And you can understand why. Because this is an associate. Yeah, an associate, we have not consolidated. We have not added anything together. So there is nothing to eliminate. Everybody is still carrying their financial statement as standalone. Remember, we do elimination in the group account to avoid double counting. Because we have receivable up there, you have payable up down there. You would have added receivable twice and payable twice, which does not make sense, which is not necessary because it's just like we are doubling up the group account. So to avoid that double counting, that's why we usually eliminate and take it out. Yeah, but in associate, we don't even add up all the elements of balance sheet or of P&L. So there is no point to do any elimination. Now, the second part, which is now very important, is the provision for unrealized profits. Yeah, so this one is very important because this now you have to do an adjustment. Yeah, you have to do an adjustment. Yeah. Remember, there are two ways that this can come from. Is either you have the parent selling to associate. Remember, we said unrealized profit will come from trading between members of the same group. So parent can sell to associate, which we will call the downstream transaction from top bottom. So this comes from top to bottom and can also be from bottom to top. So which associate can also sell to the parent. And this one is the one you call upstream. And we're going to look at how we need to manage this type of transaction. But the first thing which I'm going to tell you is the fact that please note that when we make adjustment for unrealized profit, we only take into consideration the percentage, so only the group proportion, so only the group percentage of unrealized profit is adjusted. Please remember, this is different from subsidiary. In subsidiary, we always eliminate 100% all unrealized profit because consolidation is also done 100%. But here there is no consolidation, so we're only going to take the group portion of that unrealized profit. So if the investment in associate is 25%, we only take 25% of unrealized profit for adjustment. So please take note. Yeah. Now let's look at the adjustment. Let's look at upstream first. So upstream, which means here we are saying that the associate is selling to the parent. Now, like I said, it's totally different from subsidiary, but I would give you a clue that will help you for both upstream and downstream. And this is what I'm going to tell you to know where to make your adjustment. I would say think about what part of the group account, what part of the parent account will this transaction increase? So think about, I was just writing, think about, because remember, unrealized profit is almost like something is overstated and you want to take it out, right? So that's why I'm saying think about what part of parent FS has been increased. That's what you need to ask yourself. When you're able to answer this question, you might not need to memorize the adjustment because you will easily know where to adjust. When an associate sells to the parent and has made a profit, yeah, you already know that that profit will come back to parent, so impact areas. Will come back to parent as profit share, so which means parent will have gotten income that doesn't make sense. Income that was made from him is still recording it as his own income again. So profit share would have been impacted. And likewise, he would have gotten inventory at a value that is more than the normal inventory that the group should have, right? So these are the two major parts that have been impacted on the parent account. Remember, the profit that the subsidiary, that the associate has made will still come back to the parent as profit share. That is why it's impacted. An inventory that the parent received has been received at a marked up price because it has been sold by the associate. In that case, these are the two accounts that unrealized profit is being adjusted for. Anytime you are doing that for associate. In that case, what entry will you pass? You take it out from this place and take it out from this place. And that is why there will be a debit to P&L. Yeah. And that account is the profit share of associate. But profit share from associate will be debited. That is reducing it because it was overstated by the impact. Then we need to reduce the inventory as well. So this one is statement of financial position, and that is inventory. Please note that this is inventory of the parent, because that is who is keeping the inventory, right? And with how much? With percentage of group, yeah? Multiply by the total realized profit. So not total realized profit, you need to take the percentage of the group, multiply by that unrealized profit that you have. That's the amount you need to adjust for. The other part is the downstream. If you have downstream trading, here means the parent sold to associates. And in that case, not difficult. What we need to ask again is, what are the major impact areas that would have gone up because of this transaction on the parent financial statement? The first thing that will come to your mind is that cash definitely would have gone up because we have sold to associate at higher price. So That means the associate would have given us a lot of cash, more than the value of inventory that we currently have. So that has gone up. And likewise, we would have made profit. The parent would have made profit on that. So profit would have gone up. Income, because that would have gone up through the revenue P&L financial statement. So these two things are the impact areas. So and that is what we need to adjust for. But remember, we will not return the cash to the associate. So anytime you are receiving cash from the associate, and we'll see it again when we look at dividend, please always know that cash impact is adjusted for as a refund of investment. That is the way you see it, as if they are paying back the parent some amount that he paid for when he acquired the subsidiary. So for every cash he gets, that is the way the adjustment must be made. So how do you post the entry? So to remove this profit, the way you do it is to debit cost of sales. So you increase cost of sale, that will reduce the profit, and you credit investment in associate. Credit investment in associate. And this will reduce your cost of investment in associate, because remember, I said you treat it as if you are getting a refund on your investment in associate, because you are getting cash from that associate. Anytime you get cash from your associate, that's the way you treat it. And that takes me straight away to the last adjustment, which is on dividend, because this is very similar to what we have said now. When an associate pays dividend to the parent, you must likewise make an adjustment, because if you don't make adjustment, it's going to be a double count with the equity accounting that we have spoken about. Remember, when we spoke about equity accounting, we said you're going to add this. So this is already your portion that we are already accounted for in equity accounting. So we cannot start adding dividend again. So we need to make adjustment for dividend paid by the associate, right? So what are the impact areas when you get dividend? There are two parts. You get the cash, the parent company get the cash in the financial statement, and likewise, it's going to record dividend income. Yeah, you're going to record dividend income in its P&L. Right? So we need to take out those two items. Yeah, so how do we take it out? Simple. I told you, anytime cash comes in, we need to credit investment in associate, because that's a refund on the cost of investment in associate. So we'll credit investment in associate, and we're going to debit income, yeah, which is dividend income. This is P&L. We need to debit, and this is a statement of financial position, right? So please take note, because we have done equity accounting, we cannot allow dividend income to stay in the group account again, because that will be double counting. And that is it for all the adjustment. The only part that I just need to mention to you is situation where you have other comprehensive income. This is not anything difficult. If the associate has OCI item, which we call other comprehensive income, how do you deal with it? This is just straightforward. There's nothing serious. All you need to do is to take percentage of the OCI and add it as a single line in the group financial statement. You call it the percentage share of OCI from the associate. So remember, all you need to do is take percentage of group investment, multiply by OCI amount, and what do you do next? You record that as a single line, separate line, please, as a separate single line, on group financial statement. So that would be the group share of OCI of the associate. In that case, you don't have to worry too much about it. It's just 25% of that OCI figure, and you put it there. And that's how you arrive at the total comprehensive income for the group. Okay. Yeah, that is it for associate. Like I said, next video I'll be solving a question that involves parent, subsidiary, and associate. Please remember, keep liking, comment, share, and you can always reach out to me if you need any support. Until then, see you again.